Welcome back. So today we get to start chapter 6. And today I want to discuss what is a mortgagor, what is a mortgagee, what is an acceleration clause, what is an alienation clause, what is P.I.T.I, what is satisfaction of a mortgage, what is a conventional loan versus an FHA or VA loan, and I want to end today with talking about what is a straight term mortgage. So let's begin. So mortgagor, I want you to remember that the word mortgagor, as you can see on the screen, has the word mortgage in there. It has the word, so it's almost spelling out mortgage. So a mortgagor is going to be somebody, we call that person who takes out a mortgage a borrower. So a borrower, because remember, there's two ways that you can pay for real estate. You can pay all cash, or you can use other people's money, which would be the bank. So if you choose to borrow the money, you are referred to as a mortgagor. Now remember, in earlier videos, remember how we always talked about how there's a lot of terminology with OR and EE. So OR is you're giving something. You're giving, and EE, you're receiving. So in the earlier videos, we talked about how a leaseor is giving an apartment to a leasee, which is receiving an apartment. So in this case, you have the borrower, OR, is giving the principal and interest to the bank, or AKA the lender. That's what they're giving. And the mortgagee, right, which is the lender, is receiving the payment. So EE. So the lender is equals to mortgagee. Mortgagor equals borrower. Now, do not get confused for the exam and think that the borrower is the buyer. Remember, the buyer in our earlier videos is called the grantor. So a grantor is somebody that's paying with cash. The mortgagor is the person that's borrowing the funds from the bank. So please don't get this wrong by assuming that the mortgagor is the buyer. You will get it wrong. The mortgagor is the borrower. Yes, I know that they're buying property, but for exam purposes, the buyer is the grantee. So that person is paying with cash, but once you decide to borrow money, you're the mortgagor. Now, since the borrower have chosen to borrow the funds as opposed to use their own funds, right, by paying all cash, the lender needs to protect their interests. So the best way for the lender to protect their interest is to have certain clauses within the loan docs to protect their interest. Because remember, the banks are not in the business of losing money. They're in the business of making money. So one of those clauses that they will have inside of the loan is going to be called an alienation clause. So this clause protects the lender in the event that you sell the property. So alienation meaning you left the property, you're alienated from the property. So the bank wants to make sure that you pay them in full. So when you, let's say for example, later on we're going to talk about a straight term mortgage. So let's say the straight term mortgage, you have 360 payments. So you're making a payment each month for 30 years. So you have what is called a 30-year fix. So the agreement is we will loan you $1 million. You will only have to pay $4,500 to us each month. That's the agreement that you have from the lender. So when you're signing your loan docs for that $1 million, the mortgagee, the lender, has agreed to allow you not to have to give them back the $1 million right away. They're going to wait 30 years to receive that money back. Why? because they're making interest. It's the cost to borrow money. That's what interest is, right? The cost to use other people's money. So that's the benefit for them. So they spread it out over 30 years, compound interest. So the agreement is, as long as you continue to make monthly $4,500 payments for 30 years, the bank is okay. You don't have to pay them in full. But as soon as you sell the property, alienate, now the clause protects the bank in making sure that they get every penny back. You have to pay them in full. So that's the clause. Because remember, let's say you purchase a property for $1 million and then you sold it for $2 million. But you sold that property, let's say 10 years later. The bank is not going to let you just keep making a $4,500 payment for the next 20 years. No, they're like, that check that you received from the proceeds, that $1 million, you need to pay them back. So that's the reason why the lender will have the alienation clause. And remember, they're going to be attached to the title. They're going to be on the title so that you can't transfer the property to anybody else without them first being paid back in full. So that's alienation clause. The next clause that the lenders, aka mortgagees, will have to protect them is called the acceleration clause. Now, this clause is in the event that you miss your payments. So again, the agreement when you sign your loan docs was that you only had to pay $4,500 each month for 30 years. But as soon as you miss first payment, second payment, third payment, now the bank has the opportunity, typically after your third payment, after 90 days, within that clause, they have the right to foreclose on you. Now, when they're foreclosing on you, they're not foreclosing on you for those missed payments for the past 90 days. They're foreclosing on you for the full amount that's owed back to them. So that's why a lot of times people can't save their homes, because at that point, the bank is not just looking for you to just catch up again. No, at that point, you broke the agreement, which was the $4,500 each month. And because you broke that agreement, contract is broken, so now they can come and actually foreclose on you. So that's acceleration. So it goes from a $4,500 per month payment and accelerates to the full balance. So that's why it's called acceleration clause. The next one is P.I.T.I. So the P stands for principal, the I stands for interest. So earlier we said that the mortgagor is giving something to the lender. They're giving the principal and interest. So the principal is going to be the amount that's left, and then the interest is the cost, right? They're charging you a cost for those borrowed funds. So that's P.I. Another term for P.I., and this may come up in later chapters like 16, 17, is also going to be debt service. So principal plus interest equals debt service. So if you have an exam question about what is debt service, and they're going to have all these different choices, make sure you do not assume that P.I.T.I. is debt service. No. Because remember, only the principal and interest goes to the bank. T, which stands for taxes, that's going to go to the state or county. And then you got I, which is insurance, property insurance for the property in the event that the homeowner is negligent or there's some physical damage to the property. Okay, so you got P.I.T.I, principal, interest, taxes, and insurance. Typically today, you will have your payment that will include all of that. Now, the principal and interest is monthly, your taxes is annual, and your insurance payments are monthly. So what's going to happen with your taxes, which is annual, is that each month, let's say your taxes are $12,000 a year. So each month, $1,000 out of your mortgage payment is going to be held in an escrow account so that when your tax date comes due, now they can just draw those funds from that escrow account. So that's P.I.T.I, principal, interest, taxes, and insurance. Next one is satisfaction of a mortgage. To satisfy a mortgage, that means you paid it off in full. So remember, if you sell your property through the alienation clause, right, because you alienated, you moved out of your property, the bank, aka the mortgagee, wants to have you to satisfy that mortgage. So you have to pay them in full. So that's what satisfaction of mortgage is, so that you get that correct on your exam. The next one is the difference between conventional loans versus FHA, Federal Housing Administration, and VA loans, right? Veterans Affairs Administration loans. So the difference is that the FHA and VA are federal sponsored loans. Conventional loans are not connected to the federal government, which means that those conventional loans set their own standards, set their own guidelines, set their own credit scores, debt to ratio incomes, limits as far as loan amounts. FHA, VA loans, later on we're going to talk further, but for now, VA loans are guaranteed loans for our service men and women of the armed forces, and they don't have to put a down payment. It's zero down payment. FHA, which is super popular today, is they have guidelines like you need to have at least a 580 credit score. You need your debt to income ratio, right? Can only be, let's say, between 35 to 41%, meaning the amount of income that you have coming in minus your liabilities. Okay, so your debt to income ratio. So those loans, FHA and VA loans, is going to have a certain limit. So for the state of New York, let's say that limit is $1 million. It's close to that. So with FHA loans, and again, you can look this up. I'm just giving you information in order to get the questions on the exam correct. I'm not a mortgage broker. I'm not a licensed mortgage broker. So you can look it up. I believe the limits are like $949, $750 or something like that. Unlike with a conventional loan, there's no limit. But also with a conventional loan, typically they're going to want at least 10%, 20% down payment because you don't have any limits. Unlike with the VA, which is going to have a limit based upon the area of where the property is located. FHA loans, same thing. Based on the county of where you're purchasing a property, you will have low limits. So you won't be able to get an FHA beyond that. So that those funds would have to come from your personal or by gift from a family member. So that's the difference, is that FHA, VA, again, VA is to help our armed services, men and women, and the FHA is really for the middle class. So that's the reason why their limits kind of max out at around $1 million, because it's for the middle class. Conventional loans, you want to purchase a property that's $2 million, $3 million, that's why you would use a conventional loan. But typically, they're going to want a larger down payment, like I said, 5, 10, 20%. VA loan as well as FHA loan. For the most part, you can have a down payment as low as 3%. I think most of the loans are probably 3.5, but there are some programs out there where only 3% the purchase price will be your down payment. So that's the benefits that's there. All right, so now let's continue. Let's talk about a straight term mortgage. All right, so a straight term mortgage would be a mortgage where it's going to be amortized. What does amortization mean? So amortization is when it's being spread out. So typically, I go again back to my example earlier. I borrow $1 million. I get a 30-year fixed straight term mortgage. So basically, I know what my exact payments are going to be each and every month. And that's super important. One of the reasons why we had the housing crisis of 2008 was that there were all these different types of products and the mortgage payments will fluctuate. Now, later on today, we are going to discuss some of those types of loans that kind of fluctuate. But with a fixed mortgage, which you are a first-time home buyer, I encourage you to get a fixed mortgage. You want to make sure that you can plan and budget yourself around that you can plan and budget yourself around the loan amount that you know what your mortgage payments is going to be. Okay, so that is a straight term mortgage. Is you make one payment each month, spread out over 30 years, comes to 360 installment payments. All right. Like, subscribe. Make sure you are sharing these videos. I want to make sure that as many people that want to get through the licensing process and start their real estate career, whether it's investing or doing real estate, working with clients, buyers, sellers, investors, what have you, I want to make sure that they get through the licensing as quick as possible. So don't forget to like, subscribe, share the video, and I look forward to seeing you guys in the next video. Thanks again for coming to our channel. We look forward to continuing to help you and guide you through your real estate book. We are currently doing a New York real estate sales book, but later on we will follow with California sales book, Florida sales book, as well as New Jersey sales book. So look forward to those videos. One of the other things that we want to also discuss in the channel is investment, because most real estate professionals out there, they never get to learn about investment at their firm. So we want to talk about foreclosures, what type of properties you should buy. So don't forget to like and subscribe and share the video so that you'll be notified when we drop those videos. We're trying to drop at least a minimum of 3 videos per week, and we look forward to seeing you in our next video. Thank you.